Hello, everybody. Happy Monday. We are about to go into the holidays. There's been a lot of news. We're going to go over what I went over this week. Let me just stop this video real quick. So we're going to talk about a few different things today. Let me just pull up my screen. So today we're going to go over all the different things that have happened the last couple of weeks. So there's been a Fed meeting. The Fed has raised rates or dropped rates. I'm sorry. There's been a lot of things that have happened. So we're going to go into what we can expect going into Christmas and then what we might be able to expect on the other side. So what does 2025 look like? I hope everybody is excited for 2025. New year, new start, new us. It's very exciting. I think it's going to be a great year for real estate. I think it's going to be a great year for America. So I'm super excited for 2025. Let's get into it. So the first thing I wanted to talk about is the 25 basis point cut. So Jerome Powell on the 18th cut rates by another 25 basis points. So I'm going to pull up some highlights here just so I can read them to you. Some of the things that he talked about. So I took the whole meeting, analyzed it, took the transcript, and then took out the highlights. So in case you didn't watch the entire FOMC press conference, I'm going to give you the highlights of what Jerome Powell went over. And they did cut rates by 25 basis points. This is the Fed funds rate. This does not have a direct impact on mortgage rates. I mean, it does, but it's a little bit laggy, and there's debate about that. Anyway, so the big one, the Federal Open Market Committee decided to lower the target range for the federal funds rate by a 0.25 percentage point. So we went from 4.5% to 4.5% on the high end, or 4.25% to 4.5% on the high end. So we're now at 4.25 to 4.5. This marks a cumulative 1 percentage point reduction from the previous peak policy rate. So this year, so far, mostly in the last 6 months or 4 months, the Fed has cut rates by a full percentage point. So we were at 5.25 to 5.5. Now we're at 4.25 to 4.5. Now this is the Fed funds rate. And I go over this every time, but I think it's important. The Fed funds rate is the short-term lending rate that banks have to get to cover their reserve requirements. So this is the money they can borrow from the Fed to meet their reserve requirements. So it doesn't directly impact mortgage rates or bond yields, but it does in a way. And some of the things that we're seeing even though he's cutting rates and the Fed is cutting rates, bond yields aren't going down. Mortgage rates aren't necessarily going down. And we're going to talk about that today and why that's happening. But to continue to go over some of the highlights, the Fed, Jerome Powell said something really big in this meeting, and the market actually tanked that day. So he said, the committee emphasized that policy is now closer to a neutral stance, having already provided substantial accommodation this year. Policymakers plan to proceed cautiously going forward, indicating they may slow the pace of further cuts. The Fed is not on a preset course. Future decisions will depend on incoming data and evolving economic outlook. So the market had a major sell-off when Jerome Powell said this. When he said that they weren't going to cut rates that much next year, he kind of said, we're not going to cut a bunch of rates next year, and the market sold off. And one of the reasons for this is that the jobs data keeps coming back as fraudulent. So there's been massive job revisions in the BLS. So basically every month we have a jobs report, non-farm payroll, how many jobs are created. And a lot of those numbers have been government jobs or just completely fictitious altogether. So as we go through all these revisions, the Fed is getting a different outlook on what the economy might look like. So why are they cutting rates even though inflation necessarily isn't gone, right? Because one of the things that we're going to talk about is how inflation is kind of up right now. So they also talked about how inflation has come down significantly from its peak. Headline PCE inflation is around 2.5%, down from much higher levels 2 years ago. Core PCE inflation is around 2.8%, down from 5.6%. So back in the highs of inflation, we were at about 5.6%. Now we're at 2.8%. but this is still higher than the Fed's goal of 2%. Despite the improvement, recent inflation readings have been mixed, with some months showing slower progress. Longer-run inflation expectations remain well anchored. The committee still aims to reach the 2% inflation goal sustainably and is not setting for inflation lingering above that level. They're not settling for inflation lingering above that level. So he just said that their goal is 2%, and they're not settling for anything above that. So why are they cutting rates if we're not at 2% inflation? Well, this is why. Because labor market conditions. The labor market has cooled from very tight conditions but remains solid. The unemployment rate is about 4.2%, slightly higher than a year ago, but still low by historical standards. So we're seeing an uptick in unemployment, and we also have bad jobs data to base our decision making off of. So as the Fed goes through and looks at all this job data and the BLS revises its data, it's making assumptions that might not be true. So we're seeing the unemployment rate rise, and the Fed is panicking and cutting because they don't know what else to do, even though we're not at our 2% inflation goals, right? So payroll growth has slowed to a more sustainable pace, and nominal wage growth has eased. The Fed does not believe additional labor market softening is necessary to achieve its inflation target. Then in economic growth, economic activity has remained resilient with GDP growth around 2.8% in the third quarter, matching the second quarter's pace. Consumer spending is holding up well, and improving supply conditions have supported strong economic performance. But when you look at consumer spending and consumer debt, it is at all-time highs. So consumer debt is at all-time highs right now. So even though there's a lot of consumer spending going on, the debt burden for consumers is higher than it's ever been. The Fed sees the risks to its dual mandate, maximum employment and stable prices, as roughly balanced. So that is the only two objectives they have are maximum employment and stable prices. So keep inflation down and keep people going to work. So they're seeing the unemployment rate tick up. They're dropping rates, but we're still not at our inflation goal. So why are they doing this? Some of the things that they said about housing specifically, they really didn't talk a lot about housing this time. In one of the last meetings, they spoke about housing a lot. But in this meeting, they only talked about housing. They only mentioned the word actually twice. So activity in the housing market has been weak. So Chair Powell notes that activity in the housing sector is slowing down, and there is this lag to lease issue. So people that maybe we're not at highs for rent, like a lot of people didn't raise rent in the last 3 years, right? So now when these properties are changing hands, they're releasing at a much higher rent. But that's like the current market rent. That isn't necessarily going up even more. So the Fed understands that, they see that, and they're seeing that inflation rates housing is cooling down. Let me just read to you the full thing here. So housing services inflation actually is steadily coming down from now. This is a direct quote, albeit at a slower pace than we might like, but it has now come down substantially. In response to a question about inflation, Chair Powell points out that housing services inflation, a key component influencing overall price levels, has moderated significantly from its previously elevated highs. So housing and shelter costs are a major component of the PCE. And that's one of the major components that they use to gauge inflation. I believe it's like 40% of the PCE. Housing activity. The overall activity in the housing sector is described as weak compared to other areas of the economy. This likely reflects higher financing costs and reduced affordability as mortgage rates have remained elevated relative to pre-tightening levels. Housing services inflation, more on that. Although inflation in housing services had previously contributed to the overall inflationary environment, it is now steadily declining. This indicates that prices relative to rent and other housing costs are beginning to align more closer with broader economic conditions. Even though the pace of the slowdown is somewhat slower than the Federal Reserve would prefer, the improvement is still substantial and is a positive factor in the broader disinflationary trend. So they're coming after housing, but it is starting to weaken. I feel this in my career. I do real estate investment full time. Housing is weakening. The increased borrowing costs do pose a burden for borrowers. So why is the Fed dropping rates when we haven't met our inflation goal? Some people speculate that it might be because of the SAM rule. So what is the SAM rule? The SAM rule, developed by Claudia Sam, indicates a recession when the 3-month moving average of the unemployment rate rises by 0.5% points or more relative to its low over the previous 12 months. So if unemployment goes up by half a percentage point relative to its low over the previous 12 months, that has always indicated a recession in previous history. So maybe the Fed is expecting a larger economic downturn than they initially thought. So they're continually dropping rates, even though we're not at our 2% inflation goals. The Fed's decision to cut rates might be more about managing political perceptions, especially with the upcoming elections, rather than purely economic considerations, as evidenced by the market's reaction in rising long-term yields. So the SAM rule, let's look at this a little bit deeper. So as you can see here, unemployment in January 2022 was approximately 4%. It decreased significantly all the way through 2022 to 2023. And then it started spiking when the Fed started raising rates. In October of 23, we had a 3.8% inflation rate. And then January 2024, we had a 3.7% inflation rate. Since January 2024, the unemployment rate, I'm sorry, I keep saying that wrong. The unemployment rate from January of 2024 to August of 2024 has risen significantly. This triggers the SAM rule. I'm not sure if I'm saying that right, but basically Claudia Sam studied the economy and found that anytime the unemployment rate rises this fast, there's a recession that follows almost every single time. So this could be one of the reasons that the Fed is cutting rates even though they shouldn't be. Now, I also talked about some of the jobs revisions, right? So if they're going off of unemployment and they have bad data, how can they make good decisions? Let me expand on this. So the Biden administration has been, I'm not sure who controls this data, but the Biden administration is being blamed on why the numbers are wrong. So this is how big the employment data discrepancy is. So the BLS overestimates employment in 25 states for Q2 2024, with a national overestimation of up to 3 million jobs. So there might be overestimates of about 3 million jobs that were not actually added. So the data has been wrong. That's a fact. And they are revising all that data now. And some people are speculating that it might be upwards of 3 million jobs that we actually didn't create, but the BLS reported we did create. So, that's a big deal if that's true. And we'll have to stick around and see if more data revisions come out or what happens from here. Ooh. So the Fed funds rate doesn't directly impact mortgage rates. It doesn't directly impact 10-year bonds. They've been cutting rates and bond yields are still going up. So if we can see here, I'm going to zoom in on the US 10-year Treasury bond yield. It has dropped and spiked. But basically, you can see once they started dropping rates, I believe September is when they started dropping rates. And then November 5th, they dropped rates again. And then now in December, they dropped rates again. So as you can see here, there's a lag from when they're dropping rates to when we actually see the 10-year Treasury yield reflect that. So this means that investors they're kind of thinking that maybe inflation is going to pick its head up, right? they're demanding a higher yield to hold debt for 10 years. So when you buy a 10-year bond, you're basically saying that I'm going to hold on to this debt instrument for 10 years because I expect that the person that's paying me or that owes me this money is going to perform better. So if I'm getting a 4.5% yield on my debt that I'm holding for the United States government and inflation is 3%, my real return is only 1.5%. So bond investors are demanding a higher return, even though the Fed is continually cutting rates. So as you can see, the end of December or middle of December, even after the rate cut, bond yields have risen. So this is something to pay attention to, as bond investors are very smart and they are very macro oriented. They're looking at indicators like inflation. And what the bond market is telling me right now is that they're expecting inflation to come back. I also wanted to look at mortgage rates. So mortgage rates have come down this year, even though they haven't come down as fastly and they haven't directly correlated with the Fed funds rate. Mortgage rates have been coming down. So as you can see here, November 27th, mortgage rates on a 30-year fixed rate mortgage. This is from Freddie Mac, and this is their survey from all their regional banks. They buy up 70% of residential mortgages, so they should have a pretty good idea. The 30-year fixed rate mortgage in the 27th was 6.81%. Today, from when I did this, December 19th, the 30-year fixed rate is down to 6.72%. So that's a 9 basis point decline, even though the Fed has dropped by more than that. We've only seen a 9 basis point decline in mortgage rates. And then on the 15-year, you've seen that same decline. But a lot of this has come, it was pre-priced in, right? And for the year, we are down. I mean, what does it say here? So for the year, we're down about 0.05. That's not much. So half a basis point. And, or no, we're actually up. Yeah, this doesn't make sense. I'm going to pull up my previous presentation. I've been going over these mortgage rates every single time I do a presentation. And if we look at my presentation from September, one moment. These were the mortgage rates in September. So right here, September 19th, we had a 30-year fixed rate mortgage of 6.09% and a 15-year of 5.15. November 12th, or September 12th, we had a 30-year fixed rate at 6.2% and a 15 at 5.27. So for that week, rates came down. Now, fast forward to where we're at now, mortgage rates are up, right? So mortgage rates are up from September, even though the Fed is cutting rates. This means that investors are expecting inflation. I did want to highlight, though, that all the Fed has to do to stop mortgage rates from going up, even though they continue, that's what the market is doing. The free market is basically saying like, hey, we think inflation is coming, so we need a better yield, we need a better return on a mortgage or a bond or any long-term debt that we're going to hold for the United States because we think inflation's coming back. But all the Fed has to do is shift its policy from quantitative tightening to quantitative easing. So what is the difference between those? So quantitative easing is a monetary policy tool where a central bank like the Fed purchases longer-term securities from the open market to increase the money supply and encourage lending and investment. This is typically done when conventional monetary policy tools like lowering short-term interest rates have been exhausted, especially during economic downturns or in times of low inflation. So the Fed can buy these treasury bonds, right? So right now they have a stance of quantitative tightening where, Even though they're lowering the Fed basis rate, they're also selling off their bonds. So they hold about $5 trillion of US debt. They're the largest holder of US debt, the Federal Reserve is. Way more than China, way more than Japan, way more than any other country by at least 5 times. So the Fed holds most of the US debt. And if they enact a policy of quantitative easing and start buying up that debt again, they will artificially lower mortgage rates and bond yields. So that's all they have to do. They just have to flip the switch and say, hey, we're now in a quantitative easing phase versus quantitative tightening. So if the economy gets bad enough, they will enact this policy of quantitative easing and start buying up bonds to lower rates. The Fed has that power. This is what they did during the pandemic, and this is what they'll do again if the economy gets softer. So right now, they're still trying to reduce their balance sheet. They're selling off treasury bonds into the open market. But as soon as they need to, they can flip that switch. They can start buying up bonds, lowering the yield, making mortgage rates and everything lower. And when mortgage rates are lower, that means more people are out buying, more people are taking on debt, and more money is in the economy. So there's more activity in the economy, more things are happening. So just so you get the point of what the difference between quantitative easing and quantitative tightening is, quantitative tightening is essentially the reverse of QE, right? So the central bank reduces the money supply by selling securities or allowing them to mature without reinvestment. And this is used to combat inflation or when the economy is overheating. So this is the stance they took, I believe, ever since they started raising rates, they changed their policy from quantitative easing to quantitative tightening, but they could just as easily switch it back. So I do want to highlight that point. So this is more about how they artificially suppress the rates. So by buying bonds, the Fed directly influences the yield of those securities. When they buy up it's all supply and demand, right? So lower yields mean lower interest rates for similar securities in the market. That includes mortgage-backed securities, which then gets passed on to the customer. And then an indirect effect. So market expectations, when the Fed engages in QE, it signals to markets that it's prepared to keep monetary policy loose for an extended period, which can anchor or lower expectations for future investments. So this is called animal spirits. So animal spirits is when people are very active in the market and they're getting excited and there's more economic activity going on. So just them saying that we're going to shift our policy from quantitative tightening to quantitative easing will do this. It will encourage people to start making investments because they think it's true, the printing press is warming up. So everybody's going to start getting ready to make money, do business. Portfolio rebalancing. Investors might shift to other assets like stocks or corporate bonds, reducing yields across these assets as well. So if the open market isn't buying these bonds, why would me as an investor buy those bonds? I mean, the people a lot smarter than me are telling me, well, the Fed is saying, hey, we have to buy these bonds to lower rates. So that means not enough investors are buying them, which means why would I invest in bonds? We're probably going to put our money in equities. For me, it's going to be real estate, right? No matter what. Quantitative tightening, quantitative easing, I don't care. Real estate. But bank reserves, more reserves in banks' accounts mean banks don't have to compete as aggressively for funds, which can keep interbank lending rates lower, influencing other rates. So banks will have more money on their balance sheet to be able to lend to other people. Everything is easy. Quantitative easing basically means they're getting the printing presses ready, and here we go. So in summary, QE is used by the Fed to lower long-term interest rates and to stimulate economic activity by expanding the money supply, whereas QT is used to do the opposite, to cool down an overheating economy or to combat inflation by contracting the money supply. The effectiveness of these policies can vary based on the economic context, expectations, and the state of financial markets. So when you print money, it causes inflation. That's a fact. So I didn't want to make this all a super boring, basically, seminar about what the Fed is doing, because at the end of the day, I wouldn't believe anything the Fed says. I mean, as we've seen with the BLS, the data is bad, right? So I wouldn't believe a lot of what's going on. I would try to look at it for yourself. And what is happening is we're having a lot of technological advancements. Anytime there's technological advancements, it helps with productivity. When you increase productivity, you have more output. So this means the economy is stronger. So one of the things that is happening right now is AI is booming. We currently use it in our business, and it's being used everywhere. One of the things I wanted to highlight was Sora. So OpenAI just released Sora for everybody to use. You can apply to use Sora because during Christmas time, during this time, a lot of their developers are off. So the computers are not being used as much. So they're opening this to the public for right now. So I used Sora a little bit. I'm going to share my screen. So this is Sora. So this is an AI created video. I don't know how to get out of this. So I recently posted a video on my my Facebook and my Instagram. It was this video right here. So I prompted an astronaut buying a house as is on the moon, a normal house like on Earth. He's by himself doing an inspection. And this is what Sora generated. It's very impressive. So this is now open to the public. So you guys could have an OpenAI account and apply to be able to utilize this. This is another video I made where it was the house should be like a regular house you'd find on Earth. I mean, there's some issues. The guy just walked through a wall, right? But look at how realistic this is. I mean, this is just getting started, and this is the video side of OpenAI, Sora. This is another one. And so you can build 20-second videos. At some point, you're going to be able to build an hour-long movie by prompting a large language model. And you're going to get this type of quality, which is just phenomenal. I mean, look at this. It's phenomenal. This is AI, video editor. So that's coming. So I wouldn't believe anything that you see online because I don't believe anything I see online. Because if I have access to this as a normal person, you can only imagine what the most powerful people have access to. This was one, house buyers helping a homeowner sell their property as is, local to Scranton, Pennsylvania. So they get spelling wrong a lot. Look at this one. The girl like disappears into the floor. But yeah, so that's Sora. So that is open right now for the Christmas, for the holidays, because there's less people using it. So they have more compute. It takes a lot of compute to generate those videos, as you can imagine. Now, another thing I wanted to highlight that happened this week was the CR bill. So continuing resolution bill to fund the U.S. government. We almost had a government shutdown on Friday, but we didn't. So I'm going to go over the proposed government CR bill because this is big. This is really big. Like literally, the government was about to pass a 1,547 page continuing resolution. And then Elon Musk, Donald Trump, and other key members of the Republican Party basically stopped it from happening. So they were going to relocate an NFL stadium to Washington, D.C. So the NFL, right, has 20 billion or so a year. They make a lot of money. So they, in this continuing resolution, in this 1,500 page bill, the taxpayers were going to pay for the new NFL Washington Commanders Stadium to return to RFK Stadium in Washington, D.C. We also were going to give Congress a pay raise. amongst a lot of other things that you wouldn't expect to be in just a continuing resolution bill. So this goes on to my point of printing money, right? When we print money, we increase the monetary supply. So we increased all assets with intrinsic value. All those assets go up. When you print money, all those assets go up. Inflation goes up. So it's really hard to have the Fed do one thing and then the government be on another page. Right now, we have over $36 trillion in government debt. And it's really encouraging to see a bill like this get stopped because they were wasting our money. They're throwing our money away, right? So Elon, Trump, some other people basically stopped this from happening. They proposed a new bill, and these people aren't even in office, right? They took it from 1,547 pages down to about 150 pages. So they cut out a lot of the BS funding. They cut out a lot of the BS, right? And now we have a small bill where everyone can read. But this was the first one that I really tracked, like a continuing resolution. And so they had to vote on it on Thursday. By Friday, the government was shutting down. Wednesday is when the bill came out. So they were like, I don't know how it works completely, but Congress members were working on a bill all year. And then the Wednesday, the day before Congress was supposed to vote on it, they released it so that everybody could read it and review it. And it was 1,547 pages. I consider myself to be a really good reader, and there's no way possible that I would be able to read that bill and fully comprehend what was in that bill. So they do this so that people don't actually read the bill and they can just pass it. And everybody should be upset about this. Your congressman, your politicians that represent you should be reading the bill and they should be understanding what they're passing. But every time we pass a bill, it's rammed through because nobody has enough time to actually read it or comprehend it. And it's 1,500 pages long, right? So seeing DOGE, the Department of Government Efficiency, kill this bill in its tracks and reduce it by 10x is very encouraging. We can't have spending and money going out when we don't have the money at home. So that's something that I wanted to share with you, that I was very encouraged to see that the people actually had their voices heard and we didn't just spend. Every time the government spends money, it's a tax on you. It's literally taking money out of your pocket and it's spending it on whatever they're spending it on. So this is something to pay attention to. Like, we can't just have our money spent and our taxes go up and up and up. And when it's not directly taxed, when they print money, when they give money away, it's inflation, which eats away at the US dollars that you have in your account. So that's like a silent tax, okay? So it's really encouraging to see people finally step up, and people were calling their Congress members and saying, hey, do not vote for this bill. Do not vote for this bill. And it got shut down. And they ended up passing something that I didn't necessarily agree with anyway, but it went from 1,500 pages to 150. Like, you literally shouldn't be able to vote on a bill unless you can prove that you've read it. You should have to write an essay on each bill before you vote on it. But instead, we have a Congress where they get one day to read a 1,500-page bill and then vote on it. So how can you be a well-informed voter if you don't even know what's in the bill? And there's all this crap that's in there. So, all right. I'm not even being political. This affects real estate. This affects asset prices. This affects inflation. This affects the economy. This affects my investing career. So I want to know what's going on in the world so that I can make better investing decisions, right? I want to know if the government's going to print a bunch of money, because that means I need to go and sink all my money into real estate, because real estate prices are going to go up. I mean, we've already seen real estate prices double, in some places triple. Like, we've seen real estate prices go crazy, and that's because they're printing money. They're giving away money. So anytime you print money, asset prices go up. This is why they say, oh, the rich get richer, because the rich already have assets. It's the people that are poor that don't have assets. Okay, so if you're watching this, get some assets as soon as possible, because I doubt the government's going to stop printing money. It's a lot easier to print money than to say, hey, we're taking an austerity approach and we're not going to spend money anymore. It's a lot easier to just print it. So that's probably what's going to happen, even with Trump in office. I don't know how much they can actually do, but we do have some benefits coming, right? So we have AI, we have technological advances that are going to increase productivity drastically. So I wanted to, let me see, I forget what this link went into. Oh, these were basically what I'm thinking for 2025 in regards to real estate. So the housing market has seen a mixed trend, with some areas experiencing a decline in home prices while others witness continued growth. So like Florida, prices are getting smoked, whereas in the Northeast, prices are still going crazy. Mortgage rates have unexpectedly risen to around 7%. So even though the Fed is dropping rates, mortgage rates are still going up. So despite Federal Reserve rate cuts impacting the affordability and demand for housing, this has been influenced by factors like the 10-year Treasury yield, more than the federal funds rate. So the 10-year the bond investors, like I talked about for the first 30 minutes, are demanding a higher return because they think inflation's coming back. And if you look at the 70s, it's not like something we haven't experienced before. Existing home sales in the U.S. have reached an 8-month high in November, indicating a resilient market despite higher rates. So even though we have this high rate market, inventory is still pretty low. I do expect inventory to go up because we're not even at pre-pandemic levels yet. So a lot of people are saying, oh, the housing market is softening. We're not even at pre-pandemic levels of inventory. So I would expect inventory to go up to a normal market, right? We need to get to a balanced normal market, and that's what everybody is going for. So I would expect that to happen, or at least something like that to happen, because affordability is such an issue right now. Now, the commercial real estate thing. So there's been about $1 trillion of debt that needs to be refinanced, and it's all in the commercial real estate space. And this has been getting extended. Like I thought this year they were going to refinance it. I thought it was going to hit this year, but I guess it hasn't. So there's this massive debt burden in the commercial real estate sector that they're extending. They keep extending it. And I guess they're waiting for rates to drop low enough to where the property will still pencil. So if you bought a 100-unit building with a 3% rate, and you expected to raise rents and all that stuff, even if you did a really good job and you raised rents and you made all the improvements you wanted to, and the property is 100% occupied, going from a 3% interest rate to a 7% interest rate, that deal does not pencil anymore. Okay. I don't think enough people realize this. Like, if you're in the commercial sector of real estate, these deals are not penciling with this higher rate. So if you have a 5-year arm, so a lot of times when you get commercial debt, it's on a 5-year variable rate, 7-year variable rate, or a 3-year variable rate. So after 5 years, you either have to refinance or sell, right? And now, because rates went up so much, looking at refinancing just isn't an option. So basically, there's over $1 trillion in real estate debt that needs to be refinanced. That's probably not going to pencil on a lot of these deals, and they've been extending it. So I would expect that to come due at some point. It has to, right? Now, some global impacts. So China's real estate market has faced significant challenges, with new home sales values dropping by 6.9% from the previous year, among the country's largest real estate companies. So the situation is compounded by the bankruptcy of major developers like Evergrande, signaling broader market distress in China. So China is really struggling with their housing market right now. And I do want to highlight that real estate is super local, right? So I'm talking a lot of macro things right now, and macro effects do have effects on local markets, but your local market can be booming while the rest of the economy is soft. In specific regions like Florida, there's been a notable increase in homes for sale, particularly Airbnb rentals, with owners facing financial difficulties due to high loan burdens. This situation is seen by some as potentially leading to significant market adjustments. So not only is Florida dealing with insurance issues, affordability issues, but a lot of people, bought Airbnbs and stuff. And if we do go into a recession, the traveling goes down. People don't travel as much. People don't want to spend money. If the stock market gets hit and your 401k is tied up into the stock market, do you really want to go on a 1 month vacation to Florida or even a week vacation to Florida when you just lost half your net worth? No, you don't. So the stock market, fortunately, is still at all-time highs, but everything is overvalued. So we have to see some type of correction. I would predict there's some type of correction in the market. The National Association of Realtors also introduced new rules on real estate commissions. So the whole buyer's compensation thing, this could affect both how particularly in luxury markets, this is going to affect things because you're going to be negotiating your buyer's commission. In Pennsylvania, they passed wholesale regulations. So that was where you would put a property under contract and you would assign your rights to the contract to somebody else, taking an assignment fee. That will be gone in Pennsylvania, and a lot of other states are regulating that as well. So in Pennsylvania, they made the law SB 1173, where if you want to wholesale or sign a contract, it's considered a wholesale transaction. One, you need to be licensed and have your broker's approval. Two, you have to include a disclosure, which those are all fine, right? But the third one is the big one. There's a 30-day right to cancel for any reason. So the 30-day rescind period in a real estate contract basically makes the contract worthless. If somebody can back out for any reason whatsoever for the first 30 days you're under contract, that contract is worthless. So that is what happened to Pennsylvania. And anybody that tries to wholesale in Pennsylvania, they will have to abide by these regulations or they are committing fraud. And you will go to jail for fraud. So these are some of the developments that are happening in real estate, in the economy as a whole, in the southern market, and in the market in general. I do want to show you some of the AI stuff. I kind of go over this every time I do one of these, but AI is going to have such an impact on everybody. I'm not sure if everyone's aware of it yet, but like it's really going to have an impact. One of the things, like we're now taking calls with AI, right? There was just a call today that we got. Somebody wanted to sell their house, and our AI agent, Chris, took the call. So I'm going to show you now what that looks like. I just have to put my phone on Do Not Disturb. And I'm going to call my main website number. And you're going to see here. So when you have productivity gains, more companies have more cash to reinvest. It helps with the economy. So us personally, we're leveraging any technology we possibly can because we want to do the most we possibly can with the least. So this is our AI agent, and this is who answers the phone when somebody wants to sell their house. So I'm calling my main number right now. And it first goes to all the team members for them to answer it first. And then if nobody answers, the AI agent picks up.
We are unable to take your call right now. Please leave a message after.
Nope. Well, that's a bad demo. Let me make sure it's on right now because I just changed it. So I did have it where it was taking all of the phone calls, but then I changed it because I want to take some phone calls. I still think I do a better job than the AI agent, but not by much, to be honest with you. So let me just make this pick up because right now I think I'm calling outside of working hours. And it also might be because I'm calling my own phone. So the future is going to be, you basically have everyone has an AI agent, right? And you say, hey, I'm looking to order some pizza from my favorite pizza place. And your AI agent is going to go and call that pizza place. the pizza place is going to have an AI agent that your AI agent interacts with, and they're going to take your order, right? It's going to be a completely different world, I'm telling you. I think I'm having some issues because it's currently forwarding to my phone, so it like doesn't know what to do.
Unable to take.
Yeah. Hold on, let me call from my voice number. It wasn't working because I'm calling from the number that it's supposed to be forwarding
This call will
to.
be recorded for quality purposes.
But now I'm calling from Google Voice. So anytime somebody wants to sell and they call our website or they call whatever marketing source we have out there, they're going to get an AI agent to field that initial call. And then a human being would follow up or go on the appointment, of course.
We are unable to take your call right now.
I don't know what's going on, guys. This is a bad demo. It's not working. Are we outside of working hours? Yeah, we are. All right, I don't have it set up for the right time, I guess. Let me, so that's for that number. I don't have it set up for the right time. Okay, here we go. This number I have set up properly. I'm struggling right now. This is a bad demo. Okay, so this one's going to work because I was calling the wrong number. You can also set working hours, and if somebody calls between those working hours that the AI agent isn't assigned, then the AI agent isn't going to pick up. So like if you wanted to only pick up at midnight, the AI agent will pick up at midnight. Hello?
Hey, this is Chris with House Buying. How can I help?
Hey, Chris. My name's Jake Arnold. I was calling because I just got a piece of mail.
Hey, Jake. That's a funny coincidence since you're the owner here. What was the mail about?
The mail was about my property.
Got it. Is there anything specific about your property that you need help with?
Well, I got this piece of mail and, I wanted to see what your offer was.
I see. To give you a fair offer, we'd need some details about the property first. Could you share the address and a bit about its condition?
Yeah, the address is 1515 Einan Street, Scranton, PA, and it's in decent condition.
Thanks for that. How many bedrooms and bathrooms does it have?
It's got 3 bedrooms and 2 bathrooms.
Great, thanks. On a scale from 1 to 10, how would you rate the overall condition?
On a scale of 1 to 10, how would I rate the condition? I guess like a 6.
All right, a 6. Any major repairs or updates needed?
Yeah, it's kind of like 1970s. Everything just needs to be updated.
Got it. A bit of a vintage vibe. What's making you want to sell right now?
Well, I got this piece of mail and I just wanted to see what you're offering.
Totally understand. Jake buys properties ACES, pays cash, and can often close in around 30 days. He'll discuss everything in detail when he calls you back. Would you like him to reach out soon?
Wait, who are you then?
I'm Chris, the virtual assistant here at House Buying Solutions. I'm helping out while Jake is busy with appointments.
Okay, so when will Jake call me back?
Jake will get back to you soon to go over the details and discuss the offer. Is there a specific time that works best for you?
Can you have him call me tomorrow morning?
I'll make sure he knows to reach out to you tomorrow morning. Anything else you'd like to add?
Is he gonna have to come out to the property and see it?
Yes, Jake usually likes to see the property in person. He'll coordinate a time with you when he calls.
Okay.
Great. Thanks for reaching out, Jake. Have a good night, and Jake will be in touch soon.
Alrighty, thank you. So that's a basic demo. Sorry, I messed up a bunch of times, but that's just the beginning of AI calling and what AI is going to be able to do. So when you raise productivity of businesses and people individually, you raise their output, which in turn reduces inflation. So even though we have these inflation expectations, we also have technology that's being developed that is going to reduce this inflation. So thank you guys for joining me, and I hope you have a Merry Christmas and a great New Year. Let's have gratitude. I mean, being born in this country, you really have so much opportunity. I wake up every day with gratitude to be able to do things that I do, because if I was born somewhere else, I wouldn't have had this opportunity. So let's just be more grateful and cherish this time with loved ones and family members. Um, just being born in this country, you've already hit the lottery. And I know a lot of people say, like, oh, America isn't that great. You should go to some of these other countries. And if you look at, the top 20 companies in the world, 17 of them are in the United States. The United States and their capital markets have created more prosperity and wealth for the entire population of the earth than any other country ever in history. And you're born in this country. You should be very grateful. And you should take that opportunity and make the most of it. I feel a responsibility and a sense of gratitude to continue my family's legacy. They came over here, they were immigrants. I'm third generation, and I'm so grateful. And I can't wait for Christmas. I'm very happy to spend it with family. And I hope you have a great Christmas and a great New Year. And I'll talk to you soon.